In the year 1992, Eugene, Fama, and Kenneth French came up with a research paper called The Cross-Section of Expected Stock Returns that tried to explain why some portfolios outperform others. They discovered that there are certain risk factors that some groups of stocks possess that are persistent drivers of market outperformance. The specific group they describe in their paper are called small-cap value stocks. Since the year 1926, the small-cap value group in the US delivered an annualized return of over 14%, compared to 10% return for a US total market index representing all US stocks, or even a 10.2% for the S&P 500 index fund. The same finding holds true in international markets, where between the year 1990 and 2022, small-cap value stocks managed to deliver a significant annual average outperformance in both international developed and emerging markets compared to corresponding market-weighted index funds. The periods above were not hand-picked, but were used since that is when accurate available public stock performance information was available. But essentially, what the 1992 research paper of Fama and French concluded is that so-called value stocks tend to overperform growth stocks. And a similar thing can be observed in small-cap stocks, which historically have outperformed large-cap stocks. So in this video, I want to explain these two factors as well as the rest of the factors that have been researched later on and show you how they were discovered and their significance. And towards the end of the video, I will show you some actionable steps you can take to utilize these factors in your own portfolio in order to reap the benefits of their market overperformance. In the 1960s, William Sharpe, John Littner, and John Mossen developed the Capital Asset Pricing Model, or CAPM, which is a foundational finance formula used to calculate the expected return of an asset based on its risk relative to the overall market or market beta. Their research concluded that the optimal portfolio is the market portfolio, which is a theoretical, highly diversified investment portfolio containing every available asset in the market represented in proportion to its total market capitalization. While not a perfect example, the popular S&P 500 index is considered a diversified representation of the US equity market portfolio. And a better example would be a global equity index like the MSCI ACWI All Country World Index, for example, representing all world stocks. Their conclusion suggests that the market is always efficient, meaning that prices of stocks and bonds are correct pretty much always. This in theory should mean that you cannot add higher returns without adding more risk to your portfolio. Meaning that the optimal portfolio should be just holding a global equity index tracking ETF, and minimizing costs and taxes should be the only thing that can positively influence your returns. And for most investors, that might indeed be a great investing approach, providing a satisfactory long-term investment return without having to worry about anything else. So the market factor, or beta, which was established through the CAPM model, was the first ever discovered so-called risk factor. Accounting only for that single factor, whenever a portfolio manager exposed to the same market risk or market beta managed to outperform the index, it was said that he managed to generate alpha, which is usually attributed to managers' ability to pick the right stocks or time the market. However, it also could be attributed to specific yet undiscovered factors. Following that 1960s paper, a lot of researchers came out with papers trying to disprove the market efficiency hypothesis by suggesting that there are other factors that were not accounted for in the market pricing model. So in the year 1992, Eugene, Fama, and Kenneth French published the paper that I mentioned in the very beginning of the video, where they discovered that when comparing two portfolios with different returns, the CAPM pricing model was able to explain only 66% of the difference in returns. So they proposed a three-factor model that included the risk of small stocks and the risk of value stocks, with which they were able to explain up to 90% of the differences in returns. After that, two more factors were introduced, which are profitability and investment. Where in 2015, in their paper A 5-Factor Asset Pricing Model, Fama and French proposed a 5-factor asset pricing model, which is able to explain close to 95% of differences in returns between diversified portfolios. Meaning that not only can now almost all alpha excess returns be explained by the 5-factor model, But if you specifically target these factors, you should expect a premium in returns over a traditional market-weighted index fund utilizing only the market factor. The factors that are discovered so far by different researchers in the field are not actually just 5, but rather hundreds of factors were found that had some historical outperformance. However, in their research, Fama and French do not just show empirical evidence of factor outperformance, but instead pick the factors that they were able to comfortably explain using theory. So let's now go through each one of the 5 factors in order to see what their historical outperformance has been. All of the numbers presented will be based on the Kenneth R. French data library, where a comprehensive yearly data for each one of the factors is measured. As mentioned, the market risk is actually the oldest factor, which is the sensitivity to market risk. To achieve this, a broad equity market diversification is needed. To measure its outperformance, we have to subtract the performance of treasury bills from the performance of a market-weighted index fund. From July 1963 through December 2025, in the US, it was examined that the market risk factor delivered a 6.28% premium per year on average over treasury bills. And for international markets from 1990 to 2020, the market premium has been 2.4%. Moving forward, the outperformance of the value factor is calculated by subtracting the average returns of all companies with high price-to-book ratio from those with low price-to-book ratio. Or said simply, returns from value stocks minus returns of growth stocks. From July 1963 through December 2025, in the US, the value premium was 3.9%, and in international markets from 1990 to 2020, the value premium has been 3.01%. The calculation for the size factor follows the same logic, where the calculation is returns from small cap stocks minus returns from large cap stocks. From July 1963 through December 2025 in the US, the size premium was 2.3%, and in international markets from 1990 to 2020, the size premium has been 0.81%. While noticeable in the past, more recently the size factor is not meaningful enough by itself. The reason being is that small growth stocks underperformed by a lot, so when we remove them and are left with only small cap value stocks, we can observe a higher premium. Moving to the newer discovered factors, where firms with more robust profitability tend to outperform firms with weak profitability, especially in small caps. From July 1963 through December 2025, in the US, the profitability premium was 3.4%, and in international markets from 1990 to 2020, the premium has been 4.3%. And finally, we have the investment factor, where it was found that firms with more conservative growth of the book value of their assets tend to outperform companies with aggressive asset growth, especially in small caps. From July 1963 through December 2025, in the US, the investment premium was 3.1%, and in international markets from 1990 to 2020, the premium has been 1.34%. There is one more factor that Fama and French discuss extensively in their research, although they have historically been reluctant to include it in their core asset pricing models. And it is the momentum factor, which is the empirically observed tendency for assets that have performed well in the recent past to continue performing well in the near future, and for recent poor performance to continue underperforming. Now, so far, I guess factor tilting your portfolio sounds great, right? However, doing this can definitely have some drawbacks. Heavily tilted factor investments, such as small cap value funds and ETFs, tend to be more volatile, especially in bad economic times, and can underperform the market for prolonged periods of time. Especially if you look at the US in the past 12 to 15 years, following the 2008 financial crisis, small cap value stocks have trailed the broad market almost the entire time. Nevertheless, periods like this should not be unexpected for an investor in small cap value stocks. Since looking historically, we can see that this is definitely not the norm but rather the exception. If we look at 10 and 20-year continued rolling periods using all available data for the US, we can see that for the vast majority of periods, all factors delivered a positive premium. The same premiums are also consistent when we look at both international developed and emerging markets. An additional example is that the worst year to retire in US history was in 1968, given that up to 1984 the market delivered around 7.26% per year, where inflation during the same period was 7.22%. The market even trailed 1-month US Treasury bills that delivered 7.63% annual return during the same time. However, during that same time, the US Small Cap Value Index returned 15.8% per year. Even a greater example for this is Japan, which had a very bad market performance after the 1990s market collapse caused by the Japanese asset price bubble. The market delivered only 1.9% per year for 35 years, where a 5-factor portfolio for Japan would have delivered 4.35% per year, which is more than double the yearly return. Now we come to the part that most of you are expecting, and it is where I show you how you can implement these factors in your own investment portfolio. In the past, if you wanted to invest in factor-tilted products such as small cap value stocks, you had to invest through an asset management that uses mutual funds such as those offered by dimensional funds, which are famous for their factor-based scientific investing approach. However, the good news is that Dimensional Fund's chief investment officer departed from the company and opened his own investment fund called Avantis, where they offer a variety of either moderate factor or deep factor tilted ETFs for investors in both the US and various international markets such as Europe and Canada. In the US, they offer AVUV for US small cap value and AVDV for international developed small cap value stocks. And in Europe, they offer the AVWS ETF that invests in both the US and international developed small cap value stocks in a single ETF. There are also other alternatives in the US such as Vanguard, however their ETF have a much weaker small cap value tilt by holding more mid-cap companies and targeting a weaker value tilt. And they also do not have an exposure to the profitability, investment and momentum factors like Avantis does. Now, this does not mean that you necessarily have to tilt toward factors in your portfolio. Even though research shows that a long-term outperformance over a market-weighted index fund is expected, underperformance over more than a decade is not uncommon. So if someone is unable to stick with such investment strategy and jump ship earlier, switching to another strategy is probably the worst thing an investor could do. That is because most of investing is behavioral, so you should see which strategy best fits your risk tolerance rather than just chasing what's attractive. If you like this video and enjoyed the content, you can check this video where I explain why global equity diversification is a superior strategy to just investing in an S&P 500 index tracking ETF. Hope you enjoyed this video and I'll see you in the next one.